Today, we're diving into Redfin's 2025 housing market predictions. But first, we'll cover breaking news: President Trump's first day executive order aimed at tackling housing affordability. I'm Kathy Fettke, and welcome to The Real Well Show.
You're listening to The Real Well Show with Kathy Fettke, the real estate investor's resource.
First of all, I'm sitting outside, so you might hear some background noise. I needed to get out of the smoke in LA, and I'm down in San Diego. But today, I wanted to tell you I'm bringing on a senior economist from Redfin, Chen Zhao. You've probably heard her in the news. She's going to be discussing some of the most pressing questions in the real estate industry, from Trump's impact on real estate to how the housing market will shape up this year. We'll explore how this impacts mortgage rates, affordability, climate risk, and insurance. We'll break down what's ahead for home prices, inventory, and sales with insights investors need to stay ahead in 2025. Make sure to stick to the end because we'll discuss how real estate agents could be impacted a year out from the NAR ruling. So let's dive in.
Thanks so much, Kathy, for having me today.
So let's start with your role at Redfin. What do you do?
So yeah, I'm the head of economics research at Redfin. So our team publishes research on the housing market and on the economy, and we talk to a lot of folks in the media and disseminate that research as broadly as we can.
Well, we need it today. There's a lot of change on the horizon, at least we think so. So I can't wait to hear about your predictions. But before we do that, I would love to better understand these executive orders on President Trump's first day in office. What does it mean?
Yeah, of course. So, I mean, he did issue a whole lot of executive orders. I won't get into all of them. But
Yeah.
in terms of the ones that, really touch the housing market, I think there are a few to pay attention to. So, the first thing I would say is he did have an executive order saying basically we would like to lower housing costs. And it didn't really get into much more detail than that. It talked a lot about, maybe freezing some regulations and trying to lift the regulatory burden that adds to the cost of construction. But beyond that, we don't really have much, idea right now what the details might be. So it really felt like something where he was saying to the heads of several agencies, hey, look into this and then report back to me on, what you think we could do. So I think that one is a really interesting one. We can't say very much about what the effects might actually be right now, but certainly there could be broad impact on the housing market if they are able to find ways where they're really able to cut the regulatory burden and ease the costs of constructing housing supply.
I was going to say that's what was confusing, I think, to a lot of people is it was kind of like a command with, like how do we do this? And what was confusing to me is that it seems that these are more local issues, not a federal issue. That can the federal government come in and demand what local governments do? So again, it sounds like you're saying he's just having people look into that.
Yes, it sounds like it's the start of a conversation, if you will,
Okay.
and it certainly signals an intent, which is helpful. Like you said, the real problem here is that the federal government doesn't really have a lot of say when it comes to most of the regulatory burdens that really hamper the construction of housing supply. And so then what can the federal government actually do? I think, one option is that they can try to lean on local governments. They could say, hey, look, local governments receive a lot of federal funding for things like, Medicaid, for example. We could potentially tie some of this funding to, localities actually passing regulations that really favor expanding housing supply, for example. So that's one option. The second, I think, avenue to think about is that where the federal government has a lot more say in the housing industry is really in the housing finance side of things, so mortgages, right? And there, it is the case that there are some fees that are associated with getting a mortgage, and the government could look into is it possible to reduce or eliminate some of these fees? Could it be cheaper for people to access a mortgage? And so that's not on the housing supply side, but it could certainly help home buyers. And then, you could also think about, for example, right now, it's actually relatively difficult to access mortgage credit, right? So underwriting standards are pretty stringent right now, and it has been this way since the financial crisis. And certainly, I don't think anyone wants to go back to those days, the financial crisis days. However, you could imagine the pendulum swinging a little bit in the other direction, and that could also help to ease, costs. And increase access to housing for some part of the population, right? So there are, I think, places where the federal government can make a difference, but it will be tough, as you say, because a lot of those regulatory burdens really do sit with local governments.
Yeah, I mean, we see it every day here in California. There's been a push. Of course, it's a more left-leaning state. There's been a push to bring in more affordable housing, and yet so much is zoned for single family, and people who live in those neighborhoods don't necessarily want multifamily in the area. So this is something that has been constantly discussed here. It's one of the reasons at Real Wealth we don't build anymore in California because the regulations are so high and the expenses are so high. So it's like, how do we bring in affordable housing when the fees are so burdensome? So hopefully that will be solved. I think you just mentioned it, but this executive order on mortgage rates, he said, I think twice now at least, that, he wants to see the rates come down, but that's really more tied to the bond market. So that's confusing unless there was more monetary policy, maybe the Fed buying more mortgage-backed securities. I don't know. I mean, do you have any idea what he meant by that?
Yeah, I think that, President Trump has said many times now, both on campaign trail and since, inauguration day, that he would really like to see lower interest rates, and probably specifically lower mortgage rates.
Mhm.
As you say, most of that is really tied to monetary policy. So, what the Fed does, and the Federal Reserve is an independent entity. It does not answer to the president, it does not answer to Congress or really any elected officials at all. And that independence is really critical to its ability to carry out its mission, and its mission,
Sure.
as stated, is to keep inflation low and unemployment low, right? So that, I think, is an issue where I think the president really is just not really going to have a lot of say. However, it is also the case that since September, the Federal Reserve started cutting interest rates on September 18th of last year. They've actually cut by 100 basis points, so they cut three times in a row. And in that during that time period, even though the Fed has been cutting, mortgage rates have actually gone up from about 6.1% up to now 7.1%. So there's clearly something else, right, that's also driving mortgage rates in addition to what the Fed is doing. And that something else is a lot of this fiscal and trade policy that's coming from DC. So on the trade policy side, it really has to do with tariffs. And on the fiscal policy side, it has to do with how much money the government is going to spend and how much deficit we're going to have, as a country. So there has been a lot of interesting kind of developments on the tariff side. And so since inauguration days, Monday inauguration, what we've been watching really closely is what does it seem like President Trump wants to do with tariffs, right? So when he was on the campaign trail, what he really talked about was, we might enact 60% tariffs on all goods from China. We might enact 10% tariffs on all goods from all other countries. In response to that, what happened in bond markets is long-term interest rates really increased. So mortgage rates in particular increased a lot in response to that. Since inauguration day, I would say it really seems like he's kind of pulling back on a lot of these expectations. And I think, first of all, we have to keep in mind that when he said these things on the campaign trail, bond markets didn't price that completely into long-term rates, right? They only priced like a fraction of these expectations. They only expected him to do kind of some small but significant part of what he was saying he would do. And now, if you're listening to his rhetoric, it really is starting to sound like, well, he might not actually do much on China because now he's saying, I'm not sure I really want to, but maybe there will be a 10%, additional tariff on China. He's also talking about these potential like 25% tariffs on Mexico and Canada. He's actually said some of this stuff before. It never really came to fruition. So I think markets are sort of saying, we're not really sure, but that doesn't seem like it's the baseline case. And it also sounds like he's, kind of backing off this idea of like a universal tariff as well. So that's something that's, I think, a very fluid situation that it's hard right now to say, oh, this is what's going to happen. However, what happens with this will be a really big factor in driving mortgage rates over this coming year and potentially even beyond that. So it's something that we have to watch very closely.
E Exactly. I mean, this is the question I've been asking every economist that I've interviewed is how would the Fed cut rates in an environment where so many investors, so many economists think it's going to be a robust market? It's Trump. He's pro growth. So you don't necessarily cut rates in that kind of an environment. So it was always confusing to me, but also a lot of people said he's just bluffing, right? He's not going to do all these things because he's a businessman too. So I don't. When did you first come out with your predictions for 2025? Was it before Trump was elected?
We published our predictions, I believe, in the first week of December. So it
Okay.
was after Election Day, yes.
Okay. So has anything changed since then with your predictions from December?
Not, no, not substantially, I wouldn't say. So when we wrote down our predictions, we said that we expect that mortgage rates will stay pretty elevated on average in 2025. I believe we said 6.8%. Um, we expect them to we would expect it to be volatile. We're not saying it's just going to stay at 6.8% all year. I think there's going to be a lot of ups and there's going to be a lot of downs. But when you average it throughout the year, it's going to be a pretty high level. And that's probably what I would also predict right now. We also expected that home prices would continue to increase about 4% year over year. I think that's consistent with what I would, predict right now as well. And then in terms of transactions, we expect that this year could be a little bit better than last year. So we now know that last year we had 4.06 million existing home sales in total. And we think that we could improve by 1 or 2% if Trump dials back a lot of these, tariff plans, for example, or if the economy weakens a little bit and we get a little bit of relief on rates, maybe we'll see up to like a 7, 8, 9% increase on transactions. But we're not expecting a really huge difference this year relative to 2024.
It's so interesting because you and several other economists, lots of economists are expecting the same thing, that we'll see an increase in sales, and yet interest rates remain high, home prices remain high. So who will these buyers be buying at the most expensive time?
Yeah, I know. That's a really good question because if you look at any metrics for affordability, or if you look at any metrics for like, income relative to home prices, that ratio is completely out of whack
Yeah.
relative to like basically an equilibrium that we've seen for over a long period of time. So it does beg the question, where is this money coming from, right?
Yeah.
Yeah. And I think that a lot of it is coming from is being driven by the fact that the labor market is still really strong, right? We know the unemployment rate is about 4.1% right now. We're still adding about 180,000 jobs per month. This is a very strong labor market, despite the Fed having tried its best to really slow down the economy. And we also know that asset prices have increased a lot in recent years. So the stock market keeps just hitting record highs. We know you're seeing kind of the same thing on the crypto side. And a lot of potential home buyers are actually already existing homeowners. So they have benefited from this rapid increase in home prices. So they built a lot of, home equity in this way. So that helps to, kind of take the sting out when you're looking at really high home prices and also really high mortgage rates at the same time.
So you would say it's mostly people trading homes versus new people into the market, new home buyers. Do you have stats on how many new buyers are coming in under the scenario?
We don't have a really precise estimate for that. However, I would say that you're right that the folks who are going to be losing out in an environment like this are new home buyers.
hmm Yeah, yeah, first time buyers because I hadn't really thought about that. I guess if you're looking at this pool of homeowners who have done very well, and they maybe just want to live somewhere else. They can sell, they can take their cash and go buy somewhere else. And that keeps the market moving because even an increase in sales still keeps us very low from where we'd normally be, right? In terms of
Yes,
how,
that's right. Yeah, that's right. I think that's the thing that is important to highlight, actually, is that I think a lot of folks are saying this year is going to be a little bit better. We're going to have a little bit more transaction volume. But at the end of the day, we're talking about maybe 4 million to 4.3 ish,
Mhm.
4.4 million. Like, not a lot relative to, the pandemic years when you were hitting like, 5 million, 6 million existing home sales. 4 million was really kind of like a rock bottom, and that's where we've been sitting for the last 2 years. So it's still pretty close to that rock bottom.
Still, I think people need to hear that there's still 4 million homes trading, and with these high interest rates and high prices. So who's doing that? And it does make sense that, it could be people who already have benefited. So what other predictions did you come up with in your report for 2025 and beyond?
Yeah, I think one other kind of theme we would highlight is that affordability on the for sale side is very strained, as we just discussed, but affordability on the rental market side is a lot better, right? And that's where, if you're looking at housing as a whole, there is kind of like this bright spot for renters because we know in kind of the latest market rent data that market rents have really been flat for the last probably 2 to 3 years. And that's pretty remarkable because people's incomes have been increasing in the last 2 to 3 years. So even before adjusting for inflation, market rents have really been flat. And in some places, they've actually been falling because of how much multifamily construction there has been. So that is a bright spot for folks who are looking at their housing options. And we do think that there are going to be a significant number of folks, especially first time home buyers, who are going to look at this market and say, I will continue renting because that makes a lot more financial sense.
Well, in a lot of cases, it's half, right? You could own the home and pay twice as much, or you could rent it and maybe invest your money elsewhere.
Exactly, invest your money elsewhere. I think that's really the
Okay.
key. The other thing that I would highlight is really all the changes that are happening around climate and insurance and what that means for the housing market. So I think at this point, everyone recognizes that climate change is something that we have to really contend with. And there's a lot of significant fire, flood, storm risk in all these different parts of the country, and that the insurance industry is really not well equipped as it stands to deal with that. So we're seeing insurance premiums rising very rapidly in many parts of the country. And that has a lot of knock on effects, both for homeowners and also for the mortgage industry, because for homeowners, this is a third cost that they just really probably weren't thinking that
Yeah.
much about when they were buying their home. They were thinking about, well, what's the cost of the home? What is, how much is the mortgage rate, right? And we know that both of those things have increased a lot in recent years. But now what we're seeing is that this third thing that people have tended to forget about, that's also increasing a lot. And particularly for people who maybe bought their homes a while ago, expecting, hey, the cost of insurance, these carrying costs are going to be around, whatever it is that they estimated at the time, are now finding out it's going to be way more. And that might actually threaten their ability to stay in their home. Not to mention, it also threatens the future value of that home as an investment, right? So that has a lot of knock-on effects for these existing homeowners, but it also has implications for the companies that service these mortgages, the lenders, and the people who ultimately own the risk on these mortgages as well.
I mean, you're preaching to the choir here. I'm in California. I'm in Malibu. We already had not great insurance because we're with the California Fair Plan, and now it's bankrupt. So, who's going to insure us? And the last company we talked to who might, it was like $150,000 a year or something like that. So I think we're just going to invest in a lot of sprinkler systems. I don't know. This is a big problem that who knows how it will be solved. But I did see recently that home prices seem to be going up in the Midwest. and Northeast, but mostly the Midwest. And I would think that would be because it's more affordable there. And maybe even with higher insurance, it still works for a lot of people, especially people who can live anywhere. They can, work from home still. I mean, are you seeing that in your reports that, that there's more activity in the Midwest?
Yes, we're seeing that the markets that are doing the best right now are really the places that are more affordable. Um,
Hmm.
there also tend to be markets where it's not as easy to construct new housing. So you're
Right.
not getting a ton of new supply, right? So the markets that are the weakest are really in the Sun Belt and the South, where you both have a lot of construction, but also in some cases, for example, in Florida and in Texas, you're also seeing a lot of this climate and insurance risk problems.
Yeah.
And in the Midwest and the Northeast, there's a lot more, kind of barrier to build new housing. And at the same time, in the Midwest, especially, or in like parts of upstate New York, for example, is another example of this. You have just an overall kind of lower costs of living and lower home prices, so that those places are the ones that are sort of benefiting in this environment. However, it is also the case that, across the country, what you're seeing is this very, very slow, but still kind of gradual return to office. So it will increasingly be the case that people can't really just live wherever they
Right.
want
Yeah.
to.
Hmm.
Amazon is calling everyone back 5 days a week. JP Morgan Chase, as it, they're, I think JP Morgan Chase is the largest private sector employer in New York City, is also calling all employees back 5 days a week. And these are some of the big companies that are doing that, right? So it'll be slow, but I think, especially because we might see a gradual weakening of the labor market as well. It feels like this is really only going to like directionally change in one way, and if that is the case, then people will increasingly lose that flexibility to just live anywhere.
Wow. Yeah. I mean, how do they afford to go back to New York City or any of these expensive places? But I guess they'll have to figure that out. All right. So, with that, do you see, with all of these issues, do you see home prices increasing? I know I see economists all over the board. I think I saw one who said they're going to see home prices go up 9% next year, which obviously is very extreme. But what do you see there in terms of appreciation?
I think that our sense is that home prices will continue to appreciate this year. We're expecting them to go up 4% year over year this year. And that is mostly because we continue to see demand outstrip supply, I think. People
Hmm.
are still mostly locked in. The lock in effect is easing a little bit, and it will continue to ease over time, but it's a very slow and gradual easing. But demand is still high, I mean, it's low, but it's still relatively high relative to supply, because you do have a lot of demographic tailwinds, right? So we still have, we're kind of going through this like peak part of the millennial generation where people are hitting their prime home buying years. And so we're going to be in this for at least this year and maybe like another year or two beyond this. And that's helpful. For housing demand. However, when I look beyond, this coming year or maybe the next year, I would say that the risk for home prices is really skewed to the downside. And I'm not saying that I think home prices will all of a sudden start to fall really dramatically, but I see less potential for continued home price increases. And maybe we'll see home prices maybe more so stay flat, and especially after accounting for inflation, for example. Um, and the reason I think this, I think, is based on a few different things. One is because affordability is just completely out of whack. It's off the charts right now,
Yeah.
as we talked about at the top of this. And I think that at some point, you really have to bring it back to equilibrium. And I don't think that mortgage rates are going to do that, because I don't think mortgage rates, absent a real like severe recession or something like that, mortgage rates aren't really going back down very much.
Mhm.
I just don't see that on the horizon right now. So
Yeah.
if rates are going to stay elevated, I think the home prices eventually have to correct, but it might be a very slow correction. The second reason is because I think the demographic factors are changing. Once you look beyond the next couple of years, what you see are smaller generations, and that means less home buying demand. And then furthermore, what we saw in recent years was higher immigration numbers after the pandemic. Now with the new administration, I think we're going to see a lot less immigration. So that is another factor to contend with. But even looking beyond that, I think immigration is I don't think it's going to go back to those really high numbers in the medium or kind of longer term. Because if you look around the world, really the kind of demographic factors suggest basically smaller populations to come. So all of this is, sort of good news in the sense that we all think there's a housing shortage in this country, right? So this will help to ease some of that housing shortage. But if you're thinking solely about home buying demand and what that means to prices, I think this all adds up to basically more downside risk for prices in the more medium term.
Yeah, it seems like this all could have been pretty predictable too, because it seemed pretty obvious that the years 2020 to 2024, there was this massive bubble of millennials, coming into first time homebuyer age. And behind them is a smaller demographic, at least directly behind them. And you'd feel that impact by 2025. And then you add, the change in immigration policy with this administration. I agree with you. So with that said, there's a lot of people still saying there's a huge housing shortage. So do you think builders will come in and build more multifamily, more single family, and create more oversupply?
Well, I mean, builders have really been pulling back a lot, right? I mean, we had this kind of big building boom, and at least on the multifamily side, because we have this sort of glut of kind of inventory that's still in the pipelines. I think we still have 700,000 units that are under construction, which is just like probably double the pre-pandemic rate at this point. So builders have really been pulling back on the multifamily side. On the single family side, not as much. But I think that's mostly because of this lock-in effect that's happened that we're experiencing with existing home sales, right? So I think over time, it does feel like that on the single family side, that builders will have to start pulling back as the lock-in effect very gradually eases. But this is a very kind of gradual process. And on the multifamily side, as we work our way through this glut of inventory that's coming on, it does feel like there's room for builders to expand. But these sorts of forces that we're talking about, these sort of like demographic forces, these work on long time scales. So this is not like, next quarter or next year. This is over like the next several years, up to like the next 10 years for all of this to play out. And in the meantime, a lot of different things can happen, especially on the macroeconomic side. A lot, things can really shift on a dime sometimes, and that could
Hmm.
completely change the story.
Yeah, yeah, that makes sense. So, our listeners are mostly investors, and they might be questioning, well, if I'm not getting appreciation and if I've got to deal with these high insurance rates, does it still make sense to invest? The way we underwrite, and it's very funny because I have a property in St. Petersburg that's old. Our insurance didn't go up. I don't know why. And then we have a new property on the other coast of Florida, and we have super cheap insurance. So I'm not sure, but I know that certain areas are seeing higher insurance. We're just personally not experiencing it, and a lot of our investors. The way I write my pro formas is I put like a 3 to 4% appreciation rate. I still look at the pay down of someone's paying off your loan. So to me, it feels like we're just going into a normal investing cycle. Like nothing massive, but just the fundamentals of real estate investing. What are your thoughts on that? Is there still opportunity to invest in real estate?
I think that, everything I've said is very broad on like the
Hmm.
national scale. Um,
Yes.
in some sense, it's a little useless because like no one
Right.
actually experiences the national average, right? It's
Yeah.
like when you say like the median household, there is no actual median
What is
household.
that? Yeah.
Yeah, like who like has that experience, right? But it's the only way you can sort of talk about what's happening across the country in short like form without, talking forever.
Yeah.
Um, the I think if you're thinking about this as an investor, you really have to look at what is happening in the local market conditions, right?
Yes.
Because if you are in Kansas City, what I said about Florida, like doesn't is like completely irrelevant to you. So um I think in certain local markets, you could certainly have a lot of opportunity. At the end of the day, it's always just what is the opportunity cost of your money? What else, where, what returns would you see elsewhere? But a lot of these kind of big factors, especially around insurance and climate change and like kind of like these demographic changes, they're going to be different in different parts of the country.
Yeah, that makes sense. Okay, and then finally, on the real estate side, the real estate agent side, do you anticipate any change in commissions due to these recent NAR decisions and lawsuits?
So we're actually tracking commissions data,
Mhm.
and we, based on what we see at Redfin, through through the data that we get from our partner agents, and also through Bay Equity, which is the kind of mortgage subsidiary. Um, Redfin. And what we see in our data so far is that there really has not been much change at all overall. For the market, what we saw a little bit of compression in average commissions when the settlement was first announced last spring, but after the kind of implementation date in August, we haven't really seen any changes in commissions. When you start to separate the data out by this price segment of the market, you do start to see that for more expensive homes, it does look like commissions are decreasing a little bit. Not a lot. It's not kind of in free fall, but it is declining a little bit. And that's maybe what you would expect, because that's where there's more room for commissions to come down. But for the lower price segments, we're not really seeing any changes. That being said, I think the way we would caveat this is that these changes were implemented last August. And the winter is kind of the slower part of the, home buying season. So it's possible that when you head into the spring, when there's kind of more market activity happening, you might see more, price discovery. So that's where you might actually see some changes. But so far, there's no concrete data that really suggests there's been broad changes.
Oh, well, Chet, I just really appreciate you being here and sharing your wisdom on The Real Wealth Show. I hope we get to have you back sometime.
Well, thanks so much for having me. This has been really fun.
And thank you for joining me here on The Real Wealth Show. I hope you enjoyed it as much as I did. And if you did, definitely stay tuned for my next episode. I'm going to be interviewing Lance Lambert. He's a famous journalist, going to give us some great insights on what's to come in 2025 in regards to mortgage rates and all things housing. And of course, if you want more real estate information, just go to realwealthshow.com. We have 500 free webinars on everything from how to save taxes by investing in real estate, how to get great asset protection, which markets are the best for real estate investors. You can get a list of property managers in those emerging markets. Again, just check it out at realwealthshow.com.
Views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.